Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're going to connect two stories that on the surface look very different. One is Japan, where government bond yields have been rising, and the commentary on financial social media is busy declaring that Japan is blowing up. The other is the spring of 2023 in the U.S., when Silicon Valley Bank, Signature Bank, and First Republic all failed within weeks of each other. These events rhyme because the underlying physics is the same. Duration risk plus leverage plus flighty funding can turn paper losses into real losses in less than a weekend. The common mechanism is when rising yields break the balance sheet. So let's start with the math. When interest rates rise, the bond prices fall. That's not an opinion, that's just arithmetic. In 2022, U.S. yields moved up quickly as the U.S. and the Federal Reserve raised interest rates. Banks that had loaded up on long-duration securities at low yields were sitting on unrealized losses. And if you hold the bond paper to maturity, you get the original yield that you purchased the bonds at, and those losses stay unrealized. Those losses never happen. But a bank doesn't get to choose the timing of its liabilities. Depositors do. Silicon Valley Bank is the cleanest example. The bank held large bond portfolios that had dropped in value as the yields rose, and it had a highly concentrated depositor base with a lot of uninsured deposits. When confidence broke, deposit outflows turned into a classic run on the bank. Regulators stepped in on March 10th of 2023, and Signature failed only a few days later, also in the context of deteriorating confidence and weak risk management. First Republic lasted longer, but the story was similar. A business model dependent on low-cost deposits met a world of higher rates. These unrealized losses ballooned in its securities book. The market lost confidence, deposits fled the bank, and the bank ultimately was resolved in May of 2023. That's the pattern. Duration mismatch, concentrated funding, and a catalyst that turns those mark-to-markets into a sell in order to meet withdrawals. So now let's look at Japan. Japan has enormous government debt, well over 200% of GDP. So even modest increases in yields matter a lot because the interest expense can grow very fast relative to the size of the economy. The discussion online tends to focus on three fears. Number one, Japan as a funding currency. Rising yen forces deleveraging globally. Rising yields can also mean a devaluation in the currency. That can have massive implications for the Japanese economy and for both imports and exports. And the most important is that leverage holders of Japanese government bonds become insolvent as the prices fall. These are all legitimate concerns. But here's where Japan differs from Silicon Valley Bank in a crucial way. Who owns the bonds and who can be forced to sell? Roughly half of Japanese government bonds are owned by the Bank of Japan, the central bank. Another meaningful chunk is held by insurers, and only a small portion sits on bank balance sheets, where depositors could trigger forced selling if there was a run on the bank. 70% of Japan's bank assets are concentrated in three banks. There's another 97 regional banks and 247 Shinkin banks. The U.S., on the other hand, has a much larger banking system with way more assets. The largest banks, that top-tier group, represent 40% of all assets, so it's much less concentrated than Japan, where they have 70% concentrated in three banks. Now, a central bank can carry negative equity for a long time. It can print money. That doesn't make it painless, but it changes the nature of the crisis. Japan has additional levers. Controlling the yield curve is a known tool, essentially buying bonds to cap yields, but it usually comes with currency weakness and inflation pressure. Japan has an asset that many heavily indebted countries don't have. They are sitting on a large stockpile of foreign assets and foreign exchange reserves, about $1.3 trillion. They are the number one foreign holder of U.S. Treasuries, which could be used to support the yen if policy choices otherwise drive it down. Now, on top of that, the current context in early 2026 includes higher Japanese policy rates relative to the moves in long-term bond yields. So recent reporting put the policy rate around 0.75% and the 10-year yield in the low twos. That's after a sharp sell-off tied to fiscal expectations. So yes, the same math applies. But it's not owned primarily by flighty depositors. It's owned by mostly large institutions that can't run away. If they go, where are they going to go? So what should real estate investors take from this? There's two takeaways. Number one, don't confuse volatility with insolvency. In 2023, a bond portfolio decline did not kill every bank. It killed a few banks that paired duration exposure with unstable funding. The danger is not the mark-to-market loss, it's being forced to realize the loss at a bad time. When you underwrite lenders, you're underwriting their liability structure as much as their assets. In real estate, your construction loan or your operating accounts are counterparty risk. You want to spread your relationships across institutions and don't let convenience become concentration. Next, you want to match your duration risk with your assets and liabilities. A long-duration asset funded with short-term money is fragile. That's true for a bank and it's true for a developer. If you're building or buying long-lived assets, the discipline is boring but powerful. Secure term financing, reduce refinance risk, and keep liquidity. If you're forced to refinance during a rate spike and you're living the same story, you're just wearing different clothes. Japan's situation is a reminder that sovereign debt problems play out over years, not days, well, at least until they don't. And the 2023 bank failures were a reminder that once confidence breaks, all of those time horizons collapse. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.